Okay, Chapter 22, Budgeting. We're in the last piece now. This is on financial statements. So we've, described what budgeting is and what the objectives are and how it really is a plan for next year, and talked a little bit about how it affects people's behavior. And then we looked at different types of budgeting, and we described a master budget. So the master budget, remember, includes both the operating budget and the financial budget. On the last presentation, we looked at the basic operating budget, and now we'll finish up with the financial budgets. But remember that I know this looks overwhelming, but once you start doing problems and we do it piece by piece, it gets a lot better. Okay? So the financial budgets reflect financing and investing. All right, and I don't know if you remember the statement of cash flows. You might want to look back on it real quickly. We've got the operating piece of cash flow, statement from operations, and now we're going to look at financing and investing. So we'll look at a cash budget and the capital expenditures budget. So the cash budget estimates the expected receipts, inflows, and outflows of cash for a period of time. Okay, so receipts and disbursements, but just cash. So the primary source of cash is from sales, okay, and collections on account. You might get them, though, from issuing security or debt financing, as well as sources such as interest revenue. So to estimate cash receipts from cash sales and collections on account, we prepare a schedule of cash collections. Yeah, and this is the way we do it. This is the data for Elite Accessories. We're going to use this. And notice we've got 3 months here. We've got January, February, and March. And these are the budgeted sales. We've got a beginning accounts receivable balance of $480,000. And the way the cash comes in is like in February, we'll get 40% of January sales and then 60% of February sales. So 40% are from the month before and 60% are from the current month. Okay, and that really is the way it works in business. So the budgeted cash collected for any month is the sum of the cash collected from previous months and the current months. All right, and here's an example of we've got January sales and February sales. Now in February, we'll collect 40% from January, 432, and we'll collect 744 from the current month, 60% from the current month. So there's our total collections, 1176. Okay, and you need to know this. This is emphasized on the quiz and the exam, but it's in your homework and we'll work on it together. So this is one thing you want to understand. It's also helpful for work. I can't remember the percentage, but it's huge. It's something like 70% of small businesses fail because of cash management. All right, and this is the kind of thing that they don't know. So here's the schedule of cash collections. We've got cash collected from the prior month sales and the current month total receipts on account. We're going to do it differently than this. But this is the way your book has it, and they put everything in notes. It's the part I don't like. So in January, you would get, the accounts receivable balance was 480. Okay, and then these are sales times 40% from the prior month, and we'll do this together. Okay, I've got a better format than this. Now, cash payments are really straightforward. They've got to be budgeted for operating costs and all of your expenses. And you might have some capital expenditures that you're going to make, or dividends that you're going to pay, interest payments, long-term debt. There could be things like that too. So what we'll do is prepare a schedule of payments for manufacturing costs. And here it is, this little tiny thing here. Let's make it bigger. Okay, so just like the cash receipts, this is what we have for payments. The only difference is for payments, we tend to pay things on time. All right, but so let's say that if you pay, everything is due, within so many days, say 10 to 15 days, then you might be paying off something from the prior month. Okay, but there's never anything that we don't pay. I mean, in cash receipts, there's money that's never collectible, but not so much in cash payments. Okay, so we pay 25% of the prior month's expenses, and then 75% from the current month. Then the other thing that you need to know is these are your manufacturing costs, and depreciation is included in here. Okay, now we don't pay depreciation. That is just allocating the cost of a fixed asset over time. So this is a non-cash cost. So we would have to take the $840,000 minus $24,000 and make that our payment. And here it is. We've got, there's our manufacturing costs, and you subtract the depreciation on the machines, and there's the net manufacturing cost less depreciation. So we pay 25% of the 816, and we pay 75% of the 756, and that would be our total payments for that month. And well, here's their schedule again. I'm not crazy about this. But it's got the total payments, but it doesn't show you what it's based on. You've got to go down here. It's better when this part is up above. Now, cash budget. Cash budget is one of the most difficult things to put together in budgeting. And it's structured, we put in our estimated cash receipts minus cash payments, and then a net amount. Add the cash at the beginning of the month, and then see where we are. Okay? Most businesses have a minimum cash balance that they want to keep, like a minimum of say $20,000. Okay? So if our projected cash balance is less than the minimum, then we've got to borrow money. Okay? And the other thing they point out here is that the cash balance at the end of one month is the balance for the beginning of the next month. So here's a little problem. We've got a cash balance of $225. We pay taxes. There's quarterly interest to be paid. Or interest revenue that's coming in. We're going to purchase some sewing equipment, and we've got selling and administrative expenses. Okay? So you would take these costs and just schedule them out. Okay? And put them down in the month where they're going to be paid and for whatever amount they are. Okay? But this is a nice summary here, though, because we've got cash receipts from accounts receivable. We've got some interest revenue here, total cash receipts. And then cash payments for manufacturing costs. We figured that out before. Here's selling and administrative expense. And in February, we're going to buy some sewing equipment for $274,000. Okay? We've got interest expense in January. We've got to pay taxes in March. Here are our total cash payments. So now we'll take cash receipts minus cash payments, and it gives us a net increase-decrease. Balance at the beginning of the month it brings a balance at the end of the month, and we can see here that we've got a deficiency in February. So in February, we'll have to borrow some money. Okay, and here's an example, but these are too hard to do. I want to do it together. We'll work on problems together. This is in the textbook if you want to take a look at it, okay? What do they want? They 25% on account. The end of the month, 25% of its sales in the month of the sale, 75% in the month following the sale. So if sales on account are budgeted to be $100,000 for March and $126,000 for April, what are the cash receipts for April? We would get 75, can you see this? 75% from March, right? And then from April, we would get 25%. So it would be 75,000 plus 31. Okay, it's a pretty straightforward one. So then capital expenditures, it summarizes plans for acquiring fixed assets. And it could be machinery. Things wear out all the time and have to be replaced. And that's actually a capital plan. So a company generally looks at this over a longer period, a minimum of 5 years, so you can plan out when you have to start replacing things, okay? And things have to be ordered well in advance. Years ago, when I worked at the bank, we would order computers, big processors, 7 years in advance. Can you imagine? I don't even think they were dreamt up yet, but we had an order in for them. And here's a capital expenditures budget. Okay, we've got machinery that we're going to buy and some office equipment that we're going to buy here. That's, one way to do it. So these are extra expenditures that the company has to make. Okay, now you're at the end. Then we prepare a budget balance sheet based on the operating and financial budgets. It's dated as of the end of the period, and it's similar to a normal balance sheet, except that estimated amounts are used. Okay, so that's that. Okay, we got to work a lot of problems and you'll be in good shape.